Die Sprachübertragung beginnt jetzt. Alle Teilnehmer befinden sich im Zuhörermodus.
Hello everybody, warm welcome to our second BAI webinar of this year, the second one on infrastructure, on the asset class of infrastructure. And I'm really looking forward to this one, to be honest, because it's a topic which came up like 4 years ago when I wrote the BAI information brochure on infrastructure. And what turned out back then, measuring the performance and benchmarking private markets can be regarded as a huge challenge, not an easy task. So I'm really looking forward what has developed since then and to hear the presentation by Abhishek and Jegor. It's going to be on private markets, benchmarks for portfolio risk management and regulated institutional investors. We have two great speakers for you today. First one is Abhishek Gupta from our member company, Scientific Infra and Private Assets. Abhishek is head of business and product with more than 10 years of experience in asset management at some big players in the market, and he also holds a degree, master's degree in financial engineering and a bachelor of technology. Our second speaker, I guess most of you may know him as well because we have, I don't know how many webinars we had with him, at least one per year, I would say, or probably more. Jegor, he's CEO at Substance Over Form, our member company Substance Over Form, and brand new also since last Friday, Jegor, co-CEO at Risk Consile Group. And Jegor is responsible for reporting services, including ESG for institutional clients. Also, he's a member of various working groups at BAI, and yeah, you know him through many events at BAI. So we have two presentations for you today. The first one by Abhishek is going to ask the question or answer the questions: how should private infrastructure funds and managers be benchmarked, and to provide meaningful and comparable insights for investors. Also, it's going to be about better decision making in infrastructure investing, about best practices and emerging challenges and tools. Afterwards, we have a bit shorter presentation by Jegor on the regulatory side, on private markets benchmarks in the regulatory context of CAR, Solvency II, AnlV. And afterwards, we have time for a Q&A. However, I would like to encourage you, if there are questions during the presentations of Abhishek or Jegor, please just use the GoToWebinar tool and ask them straight away also, so we can flow them in to have a little discussion. But afterwards is fine as well. We have still time for Q&A if you need a little bit more time to think about your questions. Then let me give a brief outlook on the upcoming BAI events. Not less than 3 months left until our big flagship conference, the AIC. I guess all of you will be there at the end of April in Frankfurt, Cup Europa, once again, you all know it. And then we have a couple of more webinars coming up next week, Wednesday, on another regulatory issue, SFDR 2.0, from transparency to categories, what's changing, what's unclear, and how to prepare. Next week, Wednesday, 2 o'clock. Then 25th of February, end of February, after Carnival season is over, finally, we have our Outlook webinar together with Apobank. And in March, we have another webinar on infrastructure together with Prime Capital, the European Investment Fund, and Photovolta on growth capital strategies for small, medium enterprises. So please, Abhishek, we can start with your first presentation. Really looking forward. Thank you, Roland.
Thank you, Florian, for that introduction. And I just realized that I need to send you my updated photo. That one is 8 years ago and makes me look really, really young. But yeah, I mean, this is my first webinar with BAI, so very pleased to be speaking to your audience. I was in Frankfurt last week for your private debt symposium, and I was very pleased to see how engaged your audience is, and really glad to be talking about this important topic about private market benchmarking. I'm sure your audience knows that benchmarking in private markets is hard. It's not. It hasn't been traditionally simple and easy to do, but it doesn't have to be difficult, and that's what I'm going to talk about today. If investors understand the nuances of different types of proxies used for private markets, different types of benchmarks, and what tools are currently available, then it can be really as simple as benchmarking your public market investments. So I'm going to talk a little bit about the different types of benchmarks that are available today. But before that, just a very quick introduction of our organization, since I'm talking at your webinar for the first time. Scientific Infra Private Assets. We are a data provider in private equity and infrastructure, equity and debt asset classes. We are a venture of the EDIC Business School and have been in operation since 2019, so almost 7 years now. Today, we have grown quite a lot with about 40 plus employees. And most of the data that we provide, including the benchmarks, they're aligned with the global standards. And we take quite pride in this, that we are registered with ESMA under BMR as a benchmark provider, but also our valuation methodology is aligned with IFRS and ISO principles, and we follow proper classification standards such as TICS and PECs and so on. Just a very quick nod to our client base. You can see some names up here, but in total, our clients represent about 33 trillion in AUM today, about 1 trillion in private equity and 700 billion in infrastructure. So quite popular benchmarks that I'm going to talk about today with you and show you their benefits. Our products include 3 asset classes, like I mentioned: infrastructure, equity, debt, and private equity. Today, I'm mostly going to cover infrastructure, but with a few examples about private equity as well. The data solutions that we provide are of 2 types: indices benchmarks, which include time-weighted returns, market calibrated returns, which are updated on a monthly basis, and comparables, the data around valuation analytics that investors rely upon to understand what the market is like, where the good opportunities are in terms of risk premium, cost of equity, valuation multiples, and so on. And all this data can be accessed through 4 channels, either through a web app, an Excel add-in, a Python API, or ultimately an SFTP delivery mechanism as well. That was the quick introduction. Agenda is very simple today. I'm going to talk about benchmarking in private markets, talking about the need for benchmarks and comparing the different types of benchmarks out there, some issues, some benefits. Then I'm going to go into a bit more detail about our own benchmarking methodology, the valuation approach that we have taken, try to convince you that why this is a sound approach and how these benchmarks make sense. And finally, talk about some practical use cases that our clients currently use these benchmarks for, how it's benefiting them, and what data do they rely upon in terms of our benchmarks. So first point is a straightforward argument that benchmarking matters. A fair benchmark is the one that is representative of the investor strategy. And I don't think anybody out there would argue on this point. In fact, the dictionary itself says that a benchmark is really a point of reference against which things may be compared. So broadly speaking, a benchmark is relevant as long as it's representative of the asset class and of the strategy that an investor adopts. And this brings me to what representativity actually means. So there are 2 ways that you can think about it, either in terms of the asset class, that the asset class that the benchmark is representing, it shows its fair value, what the asset class is being measured at any given point in time, and what risk is contained in that asset class. But ultimately, to do either of those things, you required mark-to-market valuations to capture where the market prices are and what sort of volatility do you see in that asset class. But it also reflects the risk-adjusted performance in a manner that is comparable. So you can compare it with stocks, bonds, and so on, the traditional asset classes, and be able to find correlations, compare the volatility and risk figures directly against any other asset class out there, because most investors don't just invest in one asset class. They have a multi-asset class portfolio. So this comparing other asset classes is important. And finally, the point is about granularity. So representativity is not just about a broad market comparison of the asset class, but also be able to drill down and understand the specifics of different segments within that asset class. And for that, you need a very granular set of data. And to accomplish that, we provide granularity through what we call TICS tilts. TICS is the infrastructure classification company standard that we have developed, and also through geography and so on. So an example that I've taken here, that if you are looking at a core strategy in infrastructure, by design, it's going to include a lot more contracted companies because they are typically of core infrastructure, lower risk, and more conservative style. So it's important that the representativity is captured through these risk factors in a given style. And the most important thing is that benchmarking is good for the whole team. If you're talking about a CIO of a large pension fund or an insurance company, it's important that the CIO is able to deliver a strategy and to add value and to compare that, what sort of value their investment team and the manager has added to their overall asset base. And that's essential for an investment office. But if you talk about the investment team as well, a benchmark helps them compare their performance against an adequate benchmark, not against an inflation measure or against a listed proxy, which are quite different from what the investment team is investing in. And it helps them assess their own performance, but also find investment opportunities as a result. So benchmarking is not just about a retrospective comparison, but it can also be a forward-looking way to find where the investment opportunities should be available. So as a whole, it's good for the whole team that they can use benchmarks for different purposes. And the subtopic for today is also on the regulation, and Jegor is going to talk a little bit more about that. But benchmarking is even more important in that context. So for insurers or regulated investors, there are different frameworks such as VAG, Solvency 2, or even PRIPS, which requires proper measurement of risk, proper fair valuation. And for that, representative benchmarks are needed. And what we will argue later in these slides, that traditional benchmarks like CPI or listed benchmarks, they don't really represent private markets. CPI, an inflation measure, is not the same as market returns. And listed indices don't capture the universe of private markets or the risk that private markets contain. And they sort of hide the beta that's available in private markets. So we need to be careful about using these. And finally, quartiles, which is a very efficient way if you are trying to compare funds and look at each other. But really, it requires a large number of data points to make any sense. And hence, quartiles can often mislead. I'll take some real examples to elaborate on this point. And the third thing that I want to mention here is this importance for supervisors. Supervisors being the compliance team, being the risk team, or the investment office even. Benchmarking errors can lead to some serious misstated risk, distorted Sharpe ratios, or the imbalance of capital allocations, what the strategy suggested to do. And it can force some unwanted rebalancing at not the optimal time. And many LPs faced this situation a couple of years ago with the so-called denominator effect of their portfolios. So it's to avoid these type of issues. Having a representative benchmark goes a long way. Now, if we just drill down into these traditional benchmarks a little bit deeper, so this slide is talking about absolute return benchmarks, primarily looking at inflation. And if you look at the first chart, here I'm comparing the expected returns of infrastructure equity in the UK with the inflation in the UK. So you can see the big jump since 2021 in the inflation figures. Basically, if you're talking about an ex-ante view, this is what you need to look at, where the expected returns are in that asset class and what the inflation is suggesting. And we find that the correlation is about 20%. So CPI plus X type of benchmark is not representative of expected returns in the benchmark. It can't tell you what type of returns to expect in that asset class, in that market, and so on. So the benchmark is not really representative for that purpose. And on an ex-post basis, the chart on the right is comparing the realized returns in the UK infrastructure market against inflation as well. And here the correlation is basically zero. So the benchmark is either very easy to beat or it's impossible to beat depending on the period, especially since the interest rates have gone up, inflation has gone up as well. Any benchmarking measure against CPI plus is proving more and more difficult to beat, given the expected returns in infrastructure remain more moderate. Now, if we talk about the argument around listed indices, and to build this argument, I've taken the S&P Global Listed Infrastructure Index. I want to draw your attention to this table on the left side, which is showing the top 10 weights. Our first argument is that typically listed infrastructure indices contains companies that are not just pure play infrastructure. They do a lot more activities and draw revenues from many different activities than can just be infrastructure companies. And you can see the names in here. And you would agree that these companies are much bigger, much broader than what pure play infrastructure looks like, especially in private markets. Then on the right, I want you to draw this comparison by two dimensions. First, by regions, how S&P Global Listed Infrastructure Index looks by different regional classification, and against the unlisted infrastructure universe that we have mapped across 9,000 companies. And same comparison by sectors as well. So if you look at by regions, the first table on the right, you find that North America is overrepresented and other regions are massively underrepresented in that index. And that continues to be the problem with comparison against listed markets. And same with sectors. You have power companies that are way overrepresented in the benchmark, but some other sectors like renewables or social infrastructure that are far less represented in such listed proxies. So they're not representative of what private market actually looks like, and hence can't tell you anything about its performance and risk measures. And finally, the point about quartiles, the point that I was making, that they create a lot more confusion. So here I've taken the fund samples from 3 popular fund databases. And the tables are across 2012, 2015, and 2018 vintages, and showing you their top quartile, median, and bottom quartile figures. The point that we are making is that the spread is between 190 and 290 basis points, depending on the vintage. So it's very difficult to understand who is really in the top quartile when you are comparing against this metric. And more importantly, the sample of funds is so small, you can see the number of funds column, where if you start to drill down by strategy, remember the granularity argument that I was making, if you want to look at core or contracted or funds within European or German funds, you will be left with maybe 2 or 3 funds in total. So quartiling doesn't even make sense. It's not even possible to do. So there isn't enough data when you want to use quartiles for that purpose, and hence it can't be a benchmark to rely upon. This creates the perfect setup to introduce Inframetrics. Inframetrics is our solution to this benchmarking problem, and it is essentially a bottom-up database of asset-level financial data, which we use to produce revenue and dividend forecasts of hundreds of assets. Right now, it contains about 900 assets going back 25 years in history. We have also collected transaction prices, observed transaction prices in infrastructure market to calibrate risk premia against those observed deals. And by doing so, we are able to reprice every one of those 900 companies every month in our database. And that is really the key valuation approach that we have developed, and is very sound and makes the benchmarks mark to market. It's not very different from what everyone else is doing. We are essentially computing a NAV using a DCF model. The benefit is that we are not relying on appraisals, rather than we are taking the information from the market, be it observed transactions, be it the financials of those companies, be it the macro data from the market, updated right to that month. And most of these benchmarks are available within the 10 business days after the month end. So you're always getting the latest information from the market being used in the benchmark and reflect the performance of the asset class as of the last month within just 10 business days of reporting period. How we do it in a bit more flowchart style, I wanted to show you a couple of points here. So like I was saying, that we collect these transaction prices from the market. That's our first input that we get. And second is we get this financial data for each of those companies that have reported their transactions. Together, they are used to develop this valuation model. So we are basically using some of these economic factors like size, leverage, and so on. And I'll elaborate on that right after the slide. But our goal is to explain that which of these financial characteristics are useful in explaining the prices that we observe in the market today. Once we have set up this model and calibrated our risk factors, we can apply the risk factors of the companies that we didn't observe transactions upon and create a shadow price for all those companies. And this is really the powerful step, because let's say we observe transactions on 100 transactions last quarter, last month, but in our investable universe across private equity and infrastructure, we have over 1 million companies in total. We can apply those risk factors in all those companies that we have in our database and compute shadow prices for all those companies every month, and eventually use these shadow prices and aggregate them to form market indices and benchmarks and all the products that we provide today. I hope this gave you a bit more clarity, but just talking about risk factors a bit more in infrastructure, they explain why do investors pay more or less to buy infrastructure companies, and they are economically sound factors. So to start with, we have size, and we find that infrastructure companies that are relatively larger, they're also more illiquid, they're also more complex, and hence they should demand a higher premium and should be a bit cheaper. And this is what we find in our calibration as well. The size factor tends to demand a higher risk premium when we have calibrated the model. Same for leverage. Levered companies controlling for everything else, they are more likely to default, and hence they demand higher premium, and they are a bit cheaper as well. And the same goes for investment factor. We calculate it as capital expenditure over total assets of each company. And as the company is putting in more and more capex, it demands higher risk premium, because you don't know whether that capex will ultimately lead to a higher valuation. So that additional capex demands higher premium, and hence these companies are a bit cheaper as well. Now, on the flip side, profits, if a company is more profitable, it demands lower premium because it has sufficient profits to support its debt, to support its operations, and that makes it a bit more expensive. But we also have some other factors like business model and country risk and so on to control for these additional effects.
Abhishek, we have one question to throw in at this point.
Sure.
The previous slide, please. There was a question. You mentioned relatively larger infrastructure companies should be a little cheaper due to more complexity and liquidity. But the question is, what is about scale effects? Higher efficiency due to scale effects, which should make bigger companies more expensive on the flip side. What do you think about this?
Correct. That's a good point, Florian, and really good question. So the point that we are making here is that when we are talking about each of these risk factors, we are talking about controlling everything else, and just because of size. But the point that you are raising now about scaling in terms of operations will arguably also lead to higher profits. So that the company will be expensive, not because it is of larger size, but because of better scaling of operations, it's able to generate more profits. So it's the profit factor that will demand a lower premium and make it more expensive. But controlling for everything else, let's say we control for leverage, control for profit. So comparing companies which have the same leverage, same profits, and so on, and then you look at the difference in size, that alone will lead to a higher premium if the company is larger, controlling for same profits and same leverage. But because of scaling, obviously the company will have other factors that will also be different, and they will lead to those characteristics. Quite often, we are asked that why are airports so expensive? Because they are arguably very large. But our argument is exactly that airports are considered to be trophy assets, and they are expensive, not because they are large, but because they are also more profitable, and there's also a lot more demand for airports from large investors, and that makes them more expensive. It's not just the size of the airports, to take an example.
Great. I think it's clear now. Thank you.
Sure. Okay, moving on from the risk factors, just to summarize the valuation approach that I was talking about, we use exit values. So we are talking about observed transactions that represent the actual market prices, not appraisals. And hence, the results that we get, they are not smooth. They represent mark-to-market calibration of the benchmarks. A very relevant point if you are trying to measure risk or for regulatory reporting and so on. Second is we extract systematic market signals. So remember the risk factor model that I was talking about. We are essentially trying to extract out these systematic pricing factors from the market, from these transactions, and remove idiosyncratic noise on an aggregate basis. So when you are looking at a segment, you can be sure that you have captured market risks through this, through these risk factors that we were talking about, and use these signals, these risk factors, to shadow price a much larger universe that we've got in private markets. And that allows us to build robust comparables and indices by construction. They are robust because we have captured their systematic risk correctly. We have ensured that the distribution of errors is of white noise terms. So it's a bit technical, but really making sure that the model is robust in itself. And hence, our valuations are representative of the market at the aggregate level. Individually for each company, they can be far off. We accept that. But our goal, our products are at the aggregate level of the asset class or at different segments. And there, we are quite confident, and we have developed a model that is robust and represents their performance and risk characteristics. That brings me to the argument around granularity. So not just that we present these benchmarks at the asset class level, but also we maintain granularity and representativity of the universe. So here, I'm showing you the chart of our flagship infrastructure equity index, Infra 300, and comparing it with what the universe looks like for infrastructure. And we have done it by business risk. That's comparing contracted, merchant, and regulated companies, by industrial activity, and by the type of corporate structure, whether they are SPVs or corporate style companies. And you will note that Infra 300 is very representative of this market across these three dimensions. And that's really the point I was raising about representativity. So if you want to compare, let's say, out of this sample, an index for transport or an index for merchant type companies, you can be sure that we have enough data, and also it's representative of the universe that we are comparing against an infrastructure asset class. The second point is about model robustness. So representativity is not just about making sure that it's representative of the asset class, but it also represents the valuation characteristics of the asset class. So here, I'm showing you a chart of how our estimates of EBITDA multiples look by different sectors and infrastructure between the observed multiples that we see in the market in those transactions that we capture, which are about 1,200 transactions over this 24-year period, taken from PitchBook, CapIQ, and so on. And we are comparing them against the predicted multiples in each of those sectors. And you can see that along this 45-degree line, the closer it gets to that line, the perfect or the better those estimates are, the more accurate those estimates are. And you can see that almost all sectors line up very closely to that line. That means our predicted multiples are very close to observed multiples in aggregate. On this chart, I'm showing you how two of our flagship indices look like and comparing some of their risk return characteristics to show that they actually represent the performance and risk in these asset classes. And as a nod, that these indices are registered with ESMA and they're also ISCO compliant, as I was mentioning earlier. The key thing is, if you look at the chart or the table below, they represent the risk return profile of private markets. You don't get some ridiculous Sharpe ratio like 3 or 4 and so on. You see the annualized returns over 5 years or 10 years period, and you can be confident that they represent the market. They can be used in an allocation framework or a risk calculation framework, and it will work. These indices will represent what these asset classes are like. And on this chart, I'm going to take a more forward-looking view, talk about the expected returns, because the way we estimate valuations in private markets, we can also create forward-looking view of what these asset classes look like, depending on what discount rates prevail in each of those asset classes at any given point in time. So here you have got a monthly series of the expected returns in the 3 flagship indices across infrastructure equity, infrastructure debt, and private equity. That's Private 2000. And it gives you a way to understand the market, to use in a way to understand the opportunities between asset classes. And the most important thing is that they are market implied expected returns. They're not fund IRRs or manager forecasts and anything like that. And they're consistent between these asset classes, so you can compare against them and use them in a portfolio construction type exercise or allocation exercise. Now we are getting close to the final few slides, which talk about the practical use cases that some of our clients are using our benchmarks and our data for. So the first case is around benchmarking a mandate. So here we're talking about a UK pension fund that needed to benchmark their mandate with a specialized infrastructure manager. So manager invests on behalf of that UK pension fund, and we have built a tailored benchmark for that UK pension fund to compare each of the investment that manager is making on behalf of that pension fund, and also how the performance looks like historically against that mandate. The issue that they really have is the strategy is very niche, so they required very granular data to represent that strategy. And through our data set, I was talking about the granularity and so on, we have some of the official market indices that obviously allow this benchmarking use case, but we also produce hundreds of segment indices by ticks and pecks. And finally, we can build customized benchmarks using our universe of over 1 million private companies. And that is crucial to build a tailored benchmark like this, which has a very niche strategy, and to compare managers' performance and mandate overall. The second case I want to take is of the German banking network, and this will resonate well with your audience. That there was a need to support the investments of savings banks in private markets. So we worked with a service provider that provides risk solutions to these savings banks. And the difficulty was that the private market risk was very hard to benchmark consistently across institutions. So they relied upon these benchmarks that we create, hundreds of benchmarks, to support the risk framework of this bank working group. And the solution could be scaled to all the German banks because they were relying on the same benchmarks, same consistent valuation methodology, which produces risk analytics based on monthly indices, and I was saying 25 years of history and so on. So based on that, any analytics like volatility, value at risk, max drawdown is possible to calculate. And we do provide all these risk analytics, which is helpful to report for these German banks. Third case I wanted to take of a European asset manager that has many infrastructure assets, but they needed to report their valuations on a monthly basis, on a recurring basis. And for that, they relied on our comparables product. They used many metrics that we provide, such as valuation multiples, expected returns, and financials, and they customized them by ticks and pecks framework. So not just that what does the EV with the multiple or risk premium of infrastructure looks like, but even more granular that within that sector, within, let's say, airports, and Even further, it can be customized by risk factors. So not just airports, but airports with profitability of X%, leverage of Y%. How does that set look like in terms of valuation multiples, in terms of cost of equity, and then use these inputs for their internal valuation models. So again, a very powerful use case that this manager is currently using our data for to support their internal valuation framework. These use cases are, sorry, is there a question, Florian? Did I miss anything?
Yes, I think the last slide to case 3, please. I think it fits to this.
Yeah.
There was a question regarding private markets time series data is smoothed. Could you explain how you deal with smoothed time series data? I think it fits here because you mentioned appraisal-based valuations like market conditions.
Mm-hmm. Absolutely. Yeah, so that was the real problem because their own process updates valuations, but generally the full-scale model is updated on an annual basis. And if they are trying to value their assets on a monthly basis, then they have to rely on a lot of stale information that was available, let's say, December of last year when they last updated their model and all the assumptions and the business case for that asset that they are working on. And that creates smoothness because every month, if you keep relying on that stale information, then you are not updating the valuations in line with the market, in line with the interest rates, inflation, or the transaction that you see. And these are the key inputs that we are updating every month in our benchmarks. Transactions are updated every month, interest rates, inflation metrics, even the cash flow forecast. As long as we have more updated information, we update their cash flow forecast every quarter. So the information that we provide through our benchmarks, it's not smooth. It's in line with the market volatility, and hence the valuation use case is very valid using our data.
Okay, thank you. Maybe let's use the opportunity for another question which came from the audience about a technical issue regarding the risk factors. You had a couple of slides before. There was a question from the audience.
Yeah.
Could you elaborate how risk factors are incorporated in the net asset value calculation via the DCF, the discounted?
Absolutely. Yeah, so DCF has 3 main inputs, right? You need cash flow forecasts, you need an estimate of equity risk premium, and you need an interest rate expectation. So the 2 inputs are relatively easier. Cash flow forecast, if you know the business model and there is some kind of inflation linkage, then you can build a revenue forecast for an asset that you can be really confident about. It's possible. Interest rates, again, it's easy because it's a market input. You can get it from the market very easily every month. The third input, risk premium, this is where the biggest complexity is because not just that it's difficult to get, but also it has a very big impact on the ultimate NAV that you get. Even 1%, so 100 basis points incorrect risk premium, we did this analysis some time ago, can lead up to 20% error in net asset values. So getting the risk premium right is absolutely important. And our risk factors are used exactly for that purpose. When we collect transactions from the market, we calibrate the risk premium of those transactions against these factors to explain how much of leverage can explain where the risk premium is today. So as interest rates have increased, for example, investors prefer less and less leverage because it's costly to finance assets. And hence, leverage itself has, the factor price of leverage has increased. That means the same leverage, let's say 75% leverage in 2018 and 75% leverage in 2025 will cost different to investors. Today, it will demand a much higher premium, that 75% leverage, because interest rates are higher, financing is costly. And that is the effect that we are trying to capture, that today 75% leverage will mean a much higher risk premium than it did 7 years ago. And that allows us to update risk premium and use it in the DCF approach to find the valuations.
Great, makes sense. Thank you. Please.
All right, just 2 more slides, and then I'll hand it over to Jegor. So the case about large Australian pension fund, they were trying to expand their private markets program, and hence they needed benchmarks that can be used for allocation purposes, particularly because in Australia, the regulatory scrutiny is quite tight. Regulators are paying a lot more attention to how these pension funds are being managed, and their private market allocations and investments are being managed. And hence, they needed benchmarks that can represent private markets. So for that purpose, we provide data that shows reasonable, meaningful Sharpe ratios, which can be used to compare correlations with other asset classes. And not just a retrospective view of returns. We provide data on expected returns as well. And all these inputs can be used to develop capital market assumptions, which are quite relevant in any allocation framework. And that's what one of these largest Australian pension funds is using our data for, to develop their internal CMA capital market assumptions and build their allocations in private markets. Finally, this use case about global asset manager. We haven't talked about this a lot, but we have also started using our private market benchmarks to compare and rank different funds and managers in infrastructure and private equity. And this we do by using their own cash flows and NAV of each fund and manager, but comparing them against the benchmarks that we calculate and find out how much alpha they generate. So this global asset manager wants or is using our data for that purpose. They are using our benchmarks to calculate alpha in each of their fund and manager investments and track their performance over time, which manager has delivered highest alpha against private market benchmarks, and also use it to re-up their investments and find new fund selection and manager selections as well. Very relevant use case. These ranking league tables are available in both infrastructure and private equity. If you want to have a look, they're quite interesting and cover about 150 GPs in buyouts and 600 plus funds in buyouts, private equity, and 70 plus GPs in infrastructure and 500 plus funds in infrastructure. So very rich data set and ranking of each of those funds and GPs against each other. Which brings me to the final slide. So key takeaways. It's time to pick a fair benchmark for the team. It's not very dramatic, but it shows that why the traditional benchmarks are not sufficient, but benchmarking itself in private metrics is quite relevant, and it benefits everybody in the team, whether it's the CIO or the investment team and so on. And more so in the regulatory context when we are talking about high and volatile rates, inflation measures that have changed, capital markets that are taking very different turns. It's relevant to benchmark private markets appropriately. And it's not unheard of. It's very usual as the asset classes mature, especially infrastructure. It has matured quite a lot and grown quite a lot. Better data and standards become available, practices change, and it's time that investors adopt these better practices. And which is the final point, that our benchmarks are fair and they can be used by sophisticated investors. Now I'll hand it over to Jegor to talk about that regulatory angle, which is very relevant in a lot more detail.
Yes,
Jegor, over to you.
There are more questions, but I think we will have time afterwards. So first, Jegor.
Absolutely.
Please, Jegor, thank you.
Yes, thanks very much, Abhishek. I learned a lot from your presentation. I'm sure our attendees as well. Maybe before I start here, I must say that's for me it's a personal highlight of my career to have a webinar together with Abhishek and SIPA, for the reason that actually I know them for almost 10 years now. So I believe the first time I came across you guys was 2017, and that was when many asset owners and asset managers, they actually started investing on a big scale into infrastructure for the first time, some of them. And then, especially during regulatory requirements, but also because of regulatory requirements, but also because of internal requirements, they had exactly the problem: how can we benchmark and how can we calculate risks without an appropriate benchmark? That was 2017, right? So they were trying to do this with public, I don't know, share equity indices and so on. Regulators didn't like it because it was obviously not representative, and you kind of came up with infrastructure indices, quite granular for the entire market. So really well done, especially now, 9 years later, I believe, with monthly infra indices for all types of asset classes, documentation, really impressive. So glad to be able to have a webinar together with you, Abhishek. Thank you. So yes, so now the question is, why did the institutional investors such as pension funds, insurance companies, banks, why do they need those benchmarks, and how is it all related? And you can see I went big on AI here on this slide, but also on the next slides, and created this caricature where you have 3 investors who are really monitoring and trying to analyze the risk in a rather sophisticated way, as you can see. And why do they do this? So for different institutional investors, you have different regulatory requirements. Although the requirements are all kind of different, but they all stay the same. So there are, you can split it into basically 2 different parts. One is the prudent investment management. Insurers call it PPP, so triple P, which is prudent person principle. Pension funds call it PPR, which is prudent person rule. Banks call it ICAP, or it's part of ICAP, which is internal capital adequacy assessment process. So essentially what it means is that if you are a regulated investor, you can't just invest everything into, let's say, a Bitcoin, right? Because it wouldn't be prudent, and then the stakeholders paying your money, so your clients, your employees, and so on, will then be quite unhappy if you lost everything. So that is, I think, clear what the requirement is. And for illiquid assets such as infrastructure or PE, those requirements are even higher because the need for analysis is higher, since the data coverage is lower compared to liquid asset classes. So this is one part, which is prudent investment management. It was many portfolio managers of your regulated LPs have to do, and actually do this also naturally, because it's part of the investment process. The second part is the internal risk assessment, where again different regulatory frameworks again have the same requirement, including own risk and solvency assessment, or ORSA under solvency, or ICAP or ILAP, which is basically for liquidity, under CRD4. Also own risk assessment, ORA, under IROP 2. So essentially what investors need to do here is they need to review the actual risk profile of the investments based on the internal methodology. So not where the regulator comes and tells you how to calculate the risk, but where you need to review the asset class and the asset and calculate the risk based on your own approach. So you are free to define any methodology, but it is your responsibility to make sure that it appropriately captures all risks. So those are the two main capital, or the 2 main regulatory requirements. So if we then move on to the different ways of calculating risks, you'll see another amazing chart here generated by Copilot. I like especially the guy here in the middle, who seems to be definitely in the driver's seat and having everything under control. So if you look at the different analytical methods under typical risk management frameworks, you will have qualitative and quantitative methods. So for example, for investment or for manager due diligence, you typically would use some questionnaires and scoring, which is more on the qualitative side. But then for calculating financial risks of direct assets or fund assets, you would usually use more quantitative approaches, including stress testing, statistical models, deterministic models, where the value at risk concept is quite important. This is also something what you have not just in the institutional LP regulations, but also in the GP regulations or fund regulations, such as PRIPS or KITS, where you also need to calculate the value at risk. So now, if we focus on the value at risk, you we'll basically see that there are multiple steps in calculating it. But before I explain this, we maybe start with what you probably will remember from your university or do on a daily basis if you work in a risk management department. So essentially what it's telling us is what is the maximum amount you can lose within a certain period of time under a certain confidence or with a certain confidence, right? So if somebody tells you my annual value at risk is 99.9% confidence is 35% of fund NAV, it means based on your assumptions, you'll not lose more than 35% within a year with this probability. You know? So that's what you want to calculate at the end. It's something what bank CEOs in the past loved to do because they wanted to know how much can I lose within one day. And now they rolled it also out to illiquid assets. It is debatable if it actually makes sense, but in any case, the regulators love it. So regardless of what makes sense, it does make sense for illiquid assets, we have to calculate it as a regulated LP. How can we calculate it? So there are many different methods to calculate it, which I'm not going to dive in. And regardless of the method, which essentially is just a formula, the key problem with illiquid assets is the data input, because methods are known for many years now, so it's nothing, let's say, innovative, but if you feed the method with the wrong data input, then obviously the output will also be wrong. So the key question with illiquid assets is what is the data input and how can I get representative data input for my model? So in the liquid world, you will typically use actual data from the actual assets. No? So if you have a BMW share price, you have daily trade or market valuations for many years. So that's easy. But if you invest into an infrastructure fund, which is typically closed-ended in many cases, and there are no investments, no history, no NAVs, so there is nothing really to use. And since this is the situation, you need to get the data from somewhere else. And typically what you do is you get the data from a comparable asset, in this case from a comparable fund or a benchmark. So, and that is how indices play an important role in the institutional risk management, because you basically need to feed your model with a representative input, which can be an illiquid benchmark. So the key word here is not benchmark, but the key word here for the risk manager is comparable. So the comparison is key, because obviously if you use something which is not comparable, whatever comes out is not relevant for you. So now let's have a look what exactly this means. And before we look at the comparability of a benchmark to the actual risk profile, maybe also a quick word on the methodology. So if you want to calculate the value of risk on the fund level, you will not just have the actual infrastructure, let's say, or private equity risk, which you will typically model in the equity or spread risk, depending if you invest into equity or debt. But you also have obviously other risk factors, which you have in any fund, liquid or illiquid, including FX, interest rate risk, or even default risk. Default risk is typically for well, counterparties like banks or derivative counterparties. You remember Silicon Valley Bank that had a run and went bankrupt in 2023. But in any case, I guess default risk, FX risk, interest rate risk, those are normal market risk or financial risk methodologies, which has been used for many years. So nothing really, I would say, surprising happens here. So let's focus on maybe on the equity and spread risk of infrastructure assets here. And as I said before, you need benchmark data for this. So this is how you would model the this equity or spread risk of the infrastructure equity or debt fund or a private equity fund. So now, as you can see on the next slide, we need to make sure that it's comparable. So we need to take the benchmark, which is essentially like another fund, if you want, and we take our fund, where we can see in the investment strategy what the fund is supposed to invest into in the next years. And now we need to compare what we have in the benchmark to what we have in the fund. And I think it's clear that the benchmark will never be the same as the fund. So you'll always have some deviation between the actual portfolio you have and the benchmark portfolio, which is normal. So now we need to see, is the benchmark sufficiently representative or even sufficiently conservative for what I'm trying to calculate? So I show you an example of a couple of criteria, what we would typically compare if we want to argue that it's representative. So if you look at a renewables fund, right now it may be only just invested into 3 wind farms. Only renewables in Germany and France, all project finance or no corporate finance, and 100% contracted revenues, and the leverage is 2.5x on the SPV level. That's not an unusual renewables fund, I would say. But then if you now take a benchmark, in the benchmark you may have 300 assets, and by the way, I took this, I believe, from the website of SIPA for the 300 Infra 300 index. Right, Abhishek, is the 300 Infra 300 index. So it's a broad index. It's not the specific renewables equity Europe index, which you also have. But I just took this one as an example for my case. So you have 300 assets. You have 27% transport and 20% renewables. We have 100% renewables. We have 79% in the EU in the benchmark, but here we have 100. We have 60% project and 40 corporate. Here we have 100% project. 75 contracted, 25 merchant versus 100, and leverage we do not know. So we would need to ask Abhishek, okay, Abhishek, what is the typical leverage you observe on the SPV level or on the company level? So is it comparable or is it not comparable? It depends on whom you ask. So you as an investor at the end of the day will have to decide if this is something where you could say this index is comparable for me, or I need to look for something more comparable. At the end of the day, you can see in my another Copilot generated picture, we're comparing here, as you say in Germany or in German, apples to pears. In English, you say apple to oranges. So you need to see, what I'm using, is it an apple or is it a pear? And can I use a pear on, let's say, total level as a fruit? So can I just model fruit, let's say, as one category instead of subdividing into apples and pears? So those are exactly the questions. And the point is, there is no right or wrong answer here. You just need to see that what you benchmark there for your total portfolio, not just for the fund, but on the total portfolio level, is sufficiently conservative. So you may even want to use a broader benchmark, but this broader benchmark might be more conservative than if you use a more dedicated benchmark. Or you may say the broader benchmark is something completely different. I really need a more narrowly defined benchmark. So those are all discussions which are, again, not 100% mathematically correct or incorrect, and also have some room for judgment and bias. Abhishek, do you agree here on this one?
Yeah, I agree. I mean, and the whole point is to get as close to the strategy as you can. I think that's the key argument. And at one point, I think you'll have to justify to regulator as well why you are picking this benchmark for that fund or that strategy, and make sure you have a good answer. So
that's it.
While you have taken Infra 300 here, like you said, I think we also have renewables Europe or very granular indices that investors can use for that purpose.
Exactly. You have also more granular, but maybe an investor doesn't want to buy an extra benchmark from you, but they already have the 300. Then they could say, okay, this is not exactly my fund, but on my total fund level, on my total balance sheet level, I invest not just in the renewables fund, but into all. So I'll model all my funds in the same way, because in total my portfolio is more comparable to Infra 300.
Yeah.
Right. Yeah. Or you could say, okay, it's not comparable, but this benchmark maybe is riskier because it has more corporate assets, which are riskier than project. It has more non-renewables, which maybe is also riskier. It has more merchant revenues. I only have contracted. It has different countries. So you could also say it's not exactly comparable, but the benchmark is riskier than what I have in my investment strategy. So that's also an approach.
I think it goes back to the point that we were talking about earlier, Jegor, about PRIPS use case, for example. So it also depends on the purpose for the benchmarking exercise. If you want to compare the whole portfolio and understand the risk profile and report on the basis of that, then fine, you can look at the broad market benchmark and that serves the purpose. But on the other hand, if you have got a use case like PRIPS reporting, which requires a very fund-specific benchmark to be able to calculate an SRI score for that fund, you need a benchmark that's also that niche and granular as the fund is. So it depends on the purpose that you're using the benchmark for as well.
Great. That exactly supports what I said at the beginning. It depends on whom you ask. Is it representative? Depends on whom you ask, right? And depends on the requirement. So so there is no ultimate benchmark. It really depends on what you're going to do with this. And any benchmark, by the way, is wrong, because no benchmark predicts the reality, right? Sorry to say this, Abhishek, but nobody knows what's going to happen tomorrow or even in the next second. But it can be good enough, at least methodologically, to argue that it's sufficiently representative and is the best we have. So no benchmark is correct, but it can be good enough for predicting the future or the risk. So in the interest of time, I'll just move on quickly. So I think backtesting is clear. Backtesting is actually a reality check. You compare your benchmark against the actual returns, and hopefully what you calculated is the value at risk was higher than your actual return. So you would see the benchmark is, you didn't violate, let's say, your value at risk. Interestingly enough, in the real estate space, we used exactly the benchmarks for real estate indices, which are quite, which are even public on by the ECB website for Europe. So basically, exactly apples with apples, and still the benchmarks were not able to predict the risk, because the sharp decline in commercial property prices in the last years was nowhere in the history and volatility. Not even during the subprime crisis in 2008 or the COVID crisis in 2020. So even if you do apples with apples, it can still happen that the future brings more unknowns that you had in the past. But this is where we are, and that's where it's also interesting. So that you always try to predict the future, but nobody can say for sure, which I guess is the definition of risk. And last point to make is equity versus debt. So equity is rather simple, because equity is you have an equity asset and you have an equity benchmark, and then what you calculate for the equity benchmark you use for your participation, and that's pretty much it. For debt is a bit difficult, because for debt, debt has is much more granular than equity, because equity is equity, but debt you can have based on different maturities, based on different ratings. You may have based on different tranches and seniority. You may have different sub-benchmarks. So within the debt benchmark, you may have sub-benchmarks. So the problem why infra and private debt managers struggle with this is that if you really want to estimate the risk correctly, on the one hand side, you need to map your portfolio to the benchmark, and you need internal ratings. So there are many managers who have internal ratings, but there are also many in the debt universe who do not have them. So if you don't have an internal rating, how do you map? So it's already a starting point where it's a bit difficult. The next thing is you need to get the ratings or the returns of a comparable peer group from the markets, and not just for your rating class, but essentially for all kinds of rating classes, because you want to stress what happens if you move from one rating category to another one, so rating transition. Again, a private debt manager will often not have an access to the market database of returns for rating classes based on durations. It's just how they do not work. So they often just don't have this data. So then, of course, it gets more difficult. And last but not least, since you might have no internal ratings on your portfolio side, but then also you don't have a market data for liquid assets. And the third point is that you don't just calculate, don't take the value of it, just apply it to your equity value, but you need to calculate a whole bunch of sub-value at risks for each duration and rating, and then aggregate it and so on. So also the calculation is much more difficult. So that risk calculations for that requires a much more granular input data and much more granular methodology, which a typical private debt manager or infra debt manager just doesn't have, because it's just not corresponding to the nature of their business. So what do they do then? One way could be to build this model, which of course takes time and resources and money. Another way could be just to say, I use the equity benchmark as a very conservative proxy of the debt benchmark. Then you basically save time on the methodology. It's much easier and you have the data, but on the other hand side, you obviously have a much higher risk. But then it's this higher risk is conservative, because that typically is more or less riskier than equity. So if you use an equity benchmark, probably you'll never fail in the validation and backtesting. Right, and that is pretty much it from my end. Sorry for for doing it longer than expected, but I think we had a couple of questions, which is a good sign, Florian, right?
Yes, it's a good sign. Thank you, Jegor, and thank you, Abhishek. We have a couple of more questions. I think we can ask some of them. I hope we do not cut short your lunch break, but we got some more interesting questions. The first one is on open-ended funds. I guess it's actually for Abhishek, but maybe Jegor also wants to add something on this issue. Open-ended funds tend to move to more frequent valuations to allow for more liquidity. However, underlying assets are just providing quarterly NAVs, often coming with a significant lag. So this lag is the issue. How can your indices facilitate and support these open-ended funds?
Absolutely, and that's a very big problem. We have been ourselves looking at evergreen or open-ended funds quite a lot in the past, and they're gaining more popularity. That's another issue, and they're also becoming more popular in retail investor market, right? Through wealth management and so on. So what we have found is that sometimes between the price and NAV of an open-ended fund, there can be a delta of up to 25%. That means that what the market is pricing the open-end fund on, if there's a unit price on that fund, versus the NAV from the underlying assets, they're not being valued fairly. Market is pricing them at a substantial delta as opposed to the valuation that the manager is calculating on. And this is where our benchmarks come in very handy, because ultimately what you want to know is whether that performance of that fund or the valuation of that fund is in line with the market, or where does it lie. And here you can compare an open-end fund depending on its strategy. If it's a broad market fund, then you can compare it against the broad market index that we provide and get a very good sense of its historical performance, rather than relying on the valuations of that fund alone. And also, as an investor, if you are really keen and you have got that sophistication, then you can also use it to value funds more appropriately if you have benchmarked it properly.
I agree, and maybe to add here, so we also see more open-ended funds in the illiquid space, that's for sure. I believe the starting point is not the risk, the starting point is really the NAV cycle. So if you start doing the NAV cycles on a monthly basis, you already have a basis to start with. And then Abhishek said they provide monthly indices. So then basically, if you have monthly NAVs and you have monthly indices, it's a match. If you don't have a monthly valuation for an open-ended fund, you already have different problems. So your risk management is the last issue you will be concerned about. You'll be more concerned how to manage your actual open-ended fund with quarterly valuation. So I think it starts with the valuations. If you get the valuations on a monthly basis, you get everything else done as well.
Right, correct. There's one more question to Jegor. Jegor, have you tried to replicate a rating-based framework similar to debt rating? For example, AA for the equity investments.
AA for the equity investments?
Yes, that was a question. Replicate a rating-based framework similar to debt rating.
Replicate, so similar to debt rating. So I'm not exactly sure I understand the question, to be honest, but the so AA for equity, I'm not sure what is AA for equity, because equity can't have a rating, right? Because equity can't, by definition, can't have a rating. So in the debt space, what can happen is that we know, so we don't, because it's not our what we do, but we know managers who really do this for private debt assets. So essentially, they do an internal rating for their asset, and then they go to the market of liquid assets and get the spreads for each duration and each rating, and then they get the liquid spreads, which obviously you can observe on the market. So now you can, based on the changes of this market spread over time, you can also adjust your illiquid spread that you have in the same way, in the same or similar way. So basically, you take your illiquid spread from the asset and you let it breathe in the same way as the market for a comparable liquid rating, let's say, breathes, because that's the beauty of debt, right? Based on duration and rating, you should be able to compare everything together. And and there are managers doing this, at least for the valuation. And then once you have this, to put it into a credit risk model is not the biggest issue then, because it's just a model at the end, right? I think the biggest topic is really the input data.
Thank you.
Sorry, just to add on that, we take an issue with that approach, Jegor, because the point is that while you can do that as a proxy and as an approximation, but we have found that what they call illiquidity premium between listed and illiquid debt, it's also not a fixed number. So you are changing your illiquid spreads in line with the listed market, but illiquidity itself keeps changing. Listed markets have a credit crunch quite often, and you want to capture that. So while we don't rate infrastructure debt is one asset class that we cover, while we don't rate it ourselves, we do calculate credit risk measures for it, like probability of default and so on, which some of our clients use to map to their internal ratings and then use the spreads based on that. So that's one solution how we are offering debt benchmarks.
Yes, there are more questions, but I think we have to keep it short at this point. Regarding market coverage, if there is a market risk data and premiums for Africa and emerging markets in general, I think to Abhishek.
Emerging markets, yes, definitely. We've got a benchmark for emerging markets and also risk premium, cost of equity, valuation multiples type data. Africa in particular, in infrastructure, it's difficult because not a lot of assets in Africa, they are available to be invested from private equity or private fund managers that easily. The secondary market activity is also much less. It's improving, but still it's not to that level that we can get data easily in that region. And hence in Africa, we have limited coverage, but emerging markets, definitely we've got a lot in South America, in Asia as well, that could be used as a proxy for that region.
Okay.
And sorry, I guess Africa is also a bit fragmented, right, Abhishek? So in the EU, I would say Spain and France somehow similar, right, or Norway. But I would argue that Egypt, Morocco, and South Africa are probably very, very different, right? So
exactly.
Africa is not Africa. Africa is a combination of countries.
All right. Thank you. I'm sorry we couldn't discuss all the questions. There were more questions, but I think we have to end at this point. Maybe you can discuss via email or get in touch with us, and we can transfer your questions. Also, the webinar the recording will be uploaded on our homepage on our YouTube channel, so you can have a look later. And so I would like to thank you once again. Would like to thank the audience for all the questions, for the interest in this topic, and want to thank you Jegor and Abhishek for your great presentations, great insights, and it was a pleasure to moderate.
Thank you so much, guys.
And glad to be here. Thank you.
See you next time. Bye.
See you next time. Bye.
See you. Bye.